The storm is coming for the global economy. The dollar is crashing. The cost of living is increasing daily. Developing countries are displaced. China has yet to recover from COVID fully. And not to forget, the Russia-Ukraine war still looms.
Well, I just spent the last few days in Washington for the annual meetings of the International Monetary Fund and the World Bank. And there are people literally starting to talk about the risk of World War III, literally, because we are in a geopolitical depression.
The U.S. has the strongest economy in the world. If the U.S. goes into recession, that means the entire global economy is in recession. And I think we're at a tipping point now.
What do you think, John? Global recession?
Yes, we're heading into a global recession. Europe isn't going to grow at all next year. The U.S. will be lucky after a couple quarters of contraction to eke out 1%. I think their numbers are right on. And I think they've actually overestimated China's growth. So when you take the European Union, China, the U.S., that's the three biggest economies in the world, puts you in a recession just with those.
The report, released as finance ministers and world leaders gathered in Washington for the World Bank IMF annual meetings, claims that the world is about to enter one of the worst periods for economic growth in the previous 2 decades, only surpassed by the 2008 global financial crisis and the start of the COVID-19 pandemic. Global growth is anticipated to rapidly slow from 6% last year to 3.2% and just 2.7% next year. You can see the line dropping. The advanced nations are on the verge of a recession, and the International Monetary Fund will publicly lower its growth predictions for 2023. Germany is expected to confess that it is already in a slump, and inflation forecasts remain high. Tharman Shanmugaratnam, Singapore's central bank chief and head of the Group of 30, a worldwide council of economic and financial leaders, warns of a perfect long storm ahead. According to him, there are no decent alternatives anymore. In a recent speech, U.S. Treasury Secretary Janet Yellen stated that the World Bank and regional development banks should begin tackling borderless concerns directly, going beyond today's country-specific funding. Yellen wants more funding without diverting resources away from other priorities. Green capital is one example of this, in which the bank finances the conservation of public goods, such as a stable climate and biodiversity. According to development and climate advocacy groups such as ONE and E3G, multilateral financial institutions should allocate $1 trillion for climate and development resilience. Yellen did not go that far, but she offered a nearly $1 billion loan to the Clean Technology Fund to assist other nations in the transition from coal. According to Mafalda Duarte, CEO of Climate Investment Funds, which oversees CTF, the U.S. loan should inspire multilateral development banks to be more imaginative in supporting climate action. IMF has a variety of concerns, but it emphasizes that the lowest income individuals and nations will be the hardest hit by inflation. In a period of uncertainty, climate change only increases the dangers. The IMF outlined 3 significant issues now impeding development in its report: Russia's invasion of Ukraine, the cost of living problem, and China's economic downturn. They produce a volatile time economically, geopolitically, and environmentally. The Ukraine war continues to powerfully undermine the global economy, generating a serious energy crisis in Europe and damage in Ukraine. No one can be sure of when the war will end, so the effect could still be more serious. Natural gas prices have doubled since 2021, with Russia delivering less than 20% of 2021 levels. As a result of the violence, food costs have also risen. Global inflation will peak in late 2022, rising from 4.7% in 2021 to 8.8% in 2022, and will stay elevated for longer than originally forecast. According to the IMF, global inflation would likely fall to 6.5% in 2023 and 4.1% in 2024. The agency emphasized the global tightening of monetary policy to battle inflation and the strong appreciation of the US dollar versus other currencies. China's zero COVID policy and the consequent lockdowns continue to harm the country's economy. Property accounts for almost 1/5 of China's GDP, and the implications are felt abroad when the market weakens. The shocks of 2022 will reopen economic scars that were only partially healed following the epidemic, according to the analysis. In its Global Financial Stability Report, issued Tuesday shortly after the World Economic Forecast, the IMF also mentioned a deteriorated economic outlook. The research stated the global environment is vulnerable, with storm clouds on the horizon. Policymakers worldwide are dealing with an unusually tough financial stability environment in which additional shocks may induce market illiquidity, disorderly sell-offs, or distress. Speaking at the 2022 Annual International Monetary Fund and the World Bank Group meetings, the World Bank's Managing Director of Operations, Axel van Trotzenberg, reinforced the view expressed in both publications. We are seeing an increase in severe poverty. The number of individuals who live on $7, that equates to 47% of the world's population living in poverty. So it's apparent that people are in pain. One can only speculate on how long this economic downturn will persist. You should also remember that the IMF just warned us and demanded that everyone prepare for how horrible 2023 would be, not specify how long we should endure all of this. More specifically, African countries are now experiencing the consequences of the global economic downturn more than any other continent. Let's not even mention African countries like Nigeria, which produce nothing. The IMF also stated that the danger of miscalibration in monetary, fiscal, or financial policy had risen considerably. At the same time, the global economy remains historically fragile, and financial markets are showing symptoms of stress. The news comes as analysts argue whether the Federal Reserve responded quickly enough to combat inflation in the United States. Meanwhile, the European Central Bank has just entered positive rate territory for the first time since 2014. The Bank of England has been forced to announce more measures this week to sustain the British economy and prevent an unwelcome rise in bond rates. The research released said that front-loaded and forceful monetary tightening is required, but that a large downturn is not inevitable, noting strong labor markets in the United States and the United Kingdom. The group also stated that fiscal policy should not be at odds with monetary authorities' efforts to contain inflation. Those remarks echoed the IMF's uncommon statement when UK Prime Minister Liz Truss announced a series of tax cuts. The IMF recommended the Truss reevaluate the fiscal program. One thing we know is that the effect wouldn't be short-lived. It's anticipated that many lower-income countries will experience economic difficulties for years to come, particularly those that have not yet recovered economically from the COVID-19 pandemic, those where schools were closed for longer periods of time, or those affected by the effects of the war in Ukraine. One thing is clear. According to the IMF, winter 2022 will be difficult for Europe, but winter 2023 will almost certainly be worse. According to the research, the oil crisis is also weighing hard on the world's economies, particularly in Europe, and it is not a transient shock. The geopolitical realignment of energy sources as a result of Russia's conflict with Ukraine is extensive and lasting. Europe's reaction to the energy crisis has been uneven. In an interview with CNBC's Hadley Gamble, U.S. Senator Chris Murphy attacked Europe's over-reliance on Russian energy, saying it was a mistake for Europe to have been welded to Russia when it comes to energy. Jamie Dimon, CEO of JP Morgan Chase, told CNBC that the crisis was quite anticipated and that the United States should have produced more oil and gas. But if we look at things realistically, the USA should be able to produce more oil and gas and not be dependent on any country. Poland's Prime Minister, Mateusz Morawiecki, described Europe's current energy problems as the repercussions of a very bad, awful policy driven by Germany. Lack of gas, extremely high gas and energy costs throughout Europe. This is the true cost of the agreement between Germany and Russia. Morawiecki told CNBC's Charlotte Reed in an exclusive interview. Risks are still leaning toward the downside, which means things could get worse than expected. For instance, there is a chance that growth will sputter to less than 2% next year, which would be extremely low and cause for concern. It might even be worse than that. Also, there's still a significant risk of food and energy shocks, particularly as the dollar's strength increases inflation. The IMF closely monitors Europe as the energy crisis is likely to have serious consequences, as real incomes are squeezed and macroeconomic stability is threatened. rising price pressures continue to pose the biggest immediate threat to current and future prosperity. The goal of restoring price stability has taken center stage for central banks, and tightening has accelerated quickly. Both under and over-tightening have risks. Under-tightening would reinforce inflation, damage central banks' reputations, and undermine inflation expectations. History has shown us that this would ultimately cost more money to control inflation. So, we are left with just one option: prepare for the worst. But how does one prepare for something when they have no idea how long it will last? Should the IMF be blamed for not creating awareness earlier regarding issues as serious as this? Comment below.